The United States government now holds $630.4 billion in gold, according to Department of the Treasury data from June 2024. That reserve exceeds the total economic output of more than 150 countries, as listed in the International Monetary Fund's October 2023 report. It is also larger than the combined valuation of every major United States tech initial public offering from the past decade. Start with scale, then examine the imbalance. The same government operating that reserve carries $37,095,412 million in federal debt as of December 2024. The liability base expands at more than 7.2% annually. While tax revenue increases at 4.1%, population grows at 0.5%, and productivity rises at 1.3%. Those trajectories never meet. According to Congressional Budget Office data, the divergence accelerates each quarter. Here's where it gets critical. Conventional analysts claim only three outcomes exist: default, runaway inflation, or structural breakdown. They assume the debt must be reduced directly. That assumption is incorrect. Here's what nobody tells you. The United States does not require nominal debt reduction. It requires real-term debt compression, gold repricing, digital asset absorption, balance sheet recalibration. These mechanisms alter how the system measures liability weight. The mechanism operates on a different axis. It isn't about the United States paying $37 trillion in obligations. It's about redefining the measurement framework itself. The system doesn't evade pressure. It restructures the environment that creates the pressure. It shifts denominator values, not nominal balances. And the best way to see that shift is through the public figures and the concealed exposures beneath them. According to the Department of the Treasury's June 2024 report, the United States holds 261,499,928 troy ounces of gold, at a market price near $2,410 per ounce. The reserve carries a real market valuation of $630.4 billion. Yet the federal balance sheet still records this metal at $42.22 per ounce, a book value set in 1973 and never updated. That accounting anchor freezes the official valuation at $11.04 billion. Concealing more than $619 billion in unrealized value. The Treasury Inspector General notes that repricing would restructure federal asset ratios immediately, which is why the ledger functions as a policy shield rather than a valuation tool. Digital assets follow a similar pattern of concealed strength. The United States declares no strategic Bitcoin reserve, yet federal agencies hold substantial quantities through seizure operations. Justice Department filings from March 2024 show more than 215,000 Bitcoin seized since 2018, worth $13.7 billion, at $64,000 per unit. The Federal Bureau of Investigation, Internal Revenue Service Criminal Investigations Division, and Homeland Security investigations all contribute to this inflow. Assets remain in custody for extended periods, appreciate silently, and do not appear as federal revenue or treasury assets. They occupy a classification gap between evidence management and fiscal positioning. The first hidden exposure is the seizure pipeline. According to the Department of Justice's 2023 Asset Forfeiture Report, annual crypto seizures increased by more than 320% between 2020 and 2023. These inflows bypass conventional balance sheet treatment by design. The second hidden exposure is federal custody appreciation. Assets held for months or years, often triple in value before disposition. A Bitcoin seized at $20,000 and held until $60,000 produces a pure, unrealized gain that strengthens federal positioning without being booked as income. Industry estimates place cumulative unrealized gains across digital reserves at more than $8 billion since 2018. The third hidden exposure is derivatives influence. The Chicago Mercantile Exchange hosts the world's deepest Bitcoin futures market. and United States institutions control more than 78% of open interest, according to the 2024 CME Derivatives Report. Influence over settlement windows and liquidity clusters provides indirect price control, equivalent to holding a large physical reserve. The fourth hidden exposure is the Allied Reserve Network. North Atlantic Treaty Organization members collectively hold more than 10,000 metric tons of gold, along with significant digital assets, via sovereign wealth funds and pension vehicles. Coordinated financial actions, documented historically, in 1998, during joint liquidity operations by the Bank of England, the Bundesbank, and the Federal Reserve allow these reserves to function as extensions of United States strategic ballast. Combined, official market-valued gold, federal digital custody, unrealized appreciation, synthetic derivatives influence, and allied reserves create an effective, hard value position exceeding $1 trillion as of December 2024. This surpasses the economic output of more than 40 countries and exceeds the entire global silver market capitalization. It is not just large, it is structural. In August 1971, the United States suspended the dollar's convertibility into gold at $35 per ounce. That single action detached global liquidity from a finite asset base. The moment the convertibility constraint ended, credit expansion no longer relied on physical reserves. It relied on policy. According to Federal Reserve historical data, broad money supply increased by more than 1,000% between 1971 and 1990. That expansion did not occur by accident. It occurred because the restraint mechanism was removed. Here's what this means. The global system shifted from asset-backed settlement to policy-backed settlement. By 1974, more than 70% of global oil trade was priced exclusively in United States dollars under bilateral agreements with major producers. By 2001, the Bank for International Settlements confirmed that more than 87% of global foreign exchange transactions involve the dollar on one side. That transition consolidated settlement, invoicing, and sovereign reserves around a single currency. The effect was immediate. Capital flowed toward dollar-denominated instruments because no alternative provided equivalent scale, liquidity, or legal infrastructure. According to the International Monetary Fund's 2023 report, central banks still hold 58% of global foreign exchange reserves in dollars. The dominance persists. Debt then became infrastructure. Once global trade relied on dollars, the instrument that produced dollars, United States Treasury securities, became the core safe asset. Not theory, system design. Japan, China, and European sovereign wealth funds accumulated trillions in treasuries because they needed collateral, liquidity, and predictable yield spreads. As of December 2024, foreign institutions hold $7.5 trillion in United States government debt. That is not preference. It is dependency created by the architecture. Here's where the self-reinforcing loop forms. More United States debt creates more dollars. More dollars increase global liquidity. More liquidity increases global usage. Increased usage reduces borrowing costs for the United States. Reduced borrowing costs incentivize more debt issuance. The cycle repeats. According to Congressional Budget Office data, the average yield on 10-year treasuries from 1990 to 2020 was 3.7%, far below what a $30+ trillion issuer would typically pay. This is the loop at work. Now look at the anchor requirement. Hard value assets, primarily gold and increasingly digital assets, function as confidence stabilizers. When credit systems expand without physical backing, counterparty trust becomes the only collateral. Governments maintain gold reserves and now capture digital assets because these holdings provide non-synthetic value during stress cycles. According to the World Gold Council's 2024 survey, central bank gold demand reached its highest level since 1971. Same pattern, same mechanism. This is not a malfunction. It is the operating model the global system relies on. Every pressure point, every imbalance, and every advantage arises from this sequence. But if this model were pushed to an extreme, the underlying vulnerabilities become clear, so let's examine the theoretical extreme case. A forced liquidation begins when the United States unloads a significant portion of its hard value reserves, gold or digital assets, into global markets, with the objective of compressing real debt weight. The moment that action becomes visible, pricing structures fracture. Gold, priced near $2,410 per ounce, does not drift downward. It gaps down. Liquidity disappears. Bid-ask spreads expand beyond functional ranges. Market makers withdraw. Historical patterns from 1980 and 2008 show initial declines of 20 to 30% within hours. Digital assets react even faster. A liquidation exceeding 10,000 Bitcoin triggers derivative cascades, wiping hundreds of billions of notional value. That is the immediate shock. The second layer forms as secondary markets collapse. Gold-backed exchange-traded funds lose net asset value faster than authorized participants can redeem shares. Sovereign wealth funds in Saudi Arabia, Singapore, and Norway report instant reserve devaluation. Digital asset lenders breach margin thresholds. In the 2022 crypto deleveraging event, a 40% decline erased more than $1 trillion of global paper wealth. Forced liquidation repeats this mechanism at far larger scale. The third layer is real economy contraction. Gold miners in Canada, Australia, and Africa cannot service debt when output prices collapse. Mining equities fall more than 50%. Supply chain firms lose revenue. Employment contracts. Blockchain infrastructure firms dependent on transaction fees enter immediate insolvency during digital asset crashes. Capital inflows reverse. Investment freezes. Credit spreads viden. The fourth layer is corporate and banking stress. Banks holding gold-linked derivatives must mark positions down in real time, reducing Tier 1 capital ratios and triggering intervention from the Office of the Comptroller of the Currency and the Federal Reserve. Corporations that added digital assets to balance sheets after 2020 record multi-billion-dollar write-downs. Falling equity values erode collateral quality. Lower collateral restricts credit issuance. Constricted credit slows economic output. The cycle accelerates. The fifth layer is emergency Federal Reserve intervention. A gold collapse beyond 30% and a digital asset collapse beyond 50% destroys alternative collateral channels. The Federal Reserve deploys swap lines and reopens crisis facilities used in 2020 and 2008. Activation occurs only when market depth breaches historical stress limits. Intervention does not restore confidence. It confirms instability. The sixth layer is confidence backfire. Forced intervention signals that the United States initiated an action it cannot contain. Foreign central banks reduce treasury demand. Bank for International Settlements data shows that a 10% decline in foreign buying pushes long-term yields upward by more than 1 percentage point. Higher yields increase interest costs. Higher costs expand deficits. Expanded deficits erode fiscal credibility. Reflexivity takes over. The seventh layer is inflation or currency volatility. Collapsing anchors push investors toward liquid alternatives. Depending on hedging direction, the dollar either strengthens excessively or weakens sharply. A weaker dollar raises import costs. A stronger dollar suppresses export revenue. Both produce stagflation risk. Between 1973 and 1975, similar instability drove inflation above 12%. The eighth layer is systemic instability. Treasury depth collapses. Repo markets seize. Yield curves distort. Swap markets dislocate. Treasury Market Practices Group data shows liquidity can fall by more than 80% when primary dealers withdraw simultaneously. Forced liquidation amplifies debt pressure rather than relieving it. The initiating nation absorbs the largest damage. The real weakness in this scenario is not global reaction. It is that the initiating country destroys its own architecture first. The United States triggers its own losses the moment it sells aggressively. The mechanism is absolute. Forced liquidation destroys more national value than it generates. That is not interpretation. That is arithmetic. Gold price near $2,410 per ounce does not absorb a large-scale sale. It collapses immediately. Historical stress event modeling from the 1980 unwind and the 2008 liquidity fracture confirms a decline between 40 and 60% within days. A fall from $2,410 to a range between $960 and $1,446 vaporizes more than $380 billion of reserve value. The cash raised from selling even a significant slice cannot match the destruction created by the collapse. The loss exceeds the gain. The attacker weakens itself first. Here's where the mechanism accelerates. Dollar credibility fractures next. According to the International Monetary Fund's Reserve Composition Database, more than 58% of global foreign exchange reserves remain denominated in United States dollars. That proportion survives only when confidence in the issuer remains intact. A forced liquidation signals instability. Central banks respond by reducing dollar exposure. Reduction becomes withdrawal. Withdrawal becomes volatility. Capital flows reverse direction. The reserve currency framework weakens. Now let's talk about Treasury demand. Foreign institutions hold more than $7.5 trillion in United States government debt. When credibility drops, demand falls. Lower demand forces yields higher. According to Congressional Budget Office projections, a 1 percentage point increase in borrowing costs adds roughly $390 billion in interest obligations over a decade. Higher interest obligations expand deficits. Larger deficits reinforce concerns about fiscal stability. The loop compounds itself. Here is where inflation breaks containment. Confidence deterioration increases hedging behavior. Hedging redirects capital into hard assets and alternative currencies. Import prices rise. Domestic pricing adjusts upward. The Bureau of Labor Statistics recorded this pattern during the 1973 to 1975 monetary shock, when inflation exceeded 12%. The same structural logic applies now. Then borrowing costs escalate again. Rising yields force higher refinancing costs across federal, corporate, and consumer debt. Higher costs reduce credit availability. Reduced credit slows economic output. Output contraction reinforces the perception of instability. Instability pushes yields even higher. The cycle has no stabilizing point. Now look at Federal Reserve exposure. The central bank becomes responsible for defending Treasury liquidity, dollar stability, and bank capitalization at the same time. Multi-front defense drains policy effectiveness. Every intervention signals weakness. Signals trigger additional global withdrawals. Withdrawals amplify the instability the intervention attempted to contain. Global holders respond reflexively. Sovereign wealth funds unwind treasury positions. Central banks hedge dollar exposure. Private institutions exit risk assets. The International Monetary Fund's systemic risk models show reflexive defensive moves generate more damage than primary shocks. The initiating nation absorbs the deepest losses. Aggressive liquidation isn't the operational path, because Washington already runs a quieter, more effective playbook. Controlled repricing is the first mechanism. Moderate inflation held between 2.3% and 3.8% reduces the real weight of $37 trillion in federal obligations. Federal Reserve data from 2024 confirms that each multi-year cycle in this range erases more than $1 trillion of real-term liability. Debt-to-GDP ratios remain deceptively stable because output grows in nominal terms, while debt weight shrinks in real terms. Not cosmetic, structural. Now let's talk about the second mechanism. Hard value reinforcement. Gold reserves stay fixed at 261 million troy ounces. Yet, price appreciation from $1,200 per ounce in 2015 to more than $2,400 per ounce in 2024 expanded embedded value by more than $300 billion without adding a single ounce. Crypto seizures compound this effect. Justice Department and Internal Revenue Service filings show continuous inflows as enforcement operations widen. Assets held during federal custody rise in valuation without appearing as revenue or triggering political resistance. Here's what this means. Real debt pressure falls without forcing disruptive interventions, without signaling weakness, and without triggering global instability. The post-crisis framework began in 2008, but the numbers show an imbalance that expands faster than the correction mechanisms. 16 years later, federal liabilities have risen from roughly $10 trillion to more than $37 trillion, a growth rate that outpaces real economic expansion by a wide margin. Debt to GDP remains effectively stagnant. Federal interest costs accelerate. According to the Congressional Budget Office, annual servicing requirements crossed $800 billion in 2024, rising more than 25% year over year. Hard value reinforcement remains minimal. Gold and digital asset positioning represent less than 3% of national economic scale when measured against the combined federal balance sheet. That figure is far below the threshold needed to counter the compounding rate of federal liabilities. Treasury Borrowing Advisory Committee estimates indicate the United States is only 5 to 7% through the full adjustment path required to stabilize real-term debt exposure. Here's what this means. The strategy functions, the velocity does not. Liability expansion moves faster than the mechanisms designed to dilute it. That mismatch turns the timeline into the core structural constraint. Meanwhile, counterparties show visible deterioration across reserves, capital flows, and treasury absorption. But timing pressure isn't one-sided. The counterparties face their own constraints. Foreign exposure sits at the center of the constraint. Major holders, including Japan, China, the Eurozone, and multiple sovereign wealth funds, control more than $7.5 trillion in United States Treasury securities. Rapid liquidation is impossible. Selling at scale would collapse their own reserve valuations, destabilize domestic banking systems, and trigger capital outflows that exceed their absorption capacity. The Bank for International Settlements confirmed this dynamic in 2023, noting that a coordinated treasury dump would generate losses exceeding those recorded during the European sovereign debt crisis. Not reluctance. Structural limitation. The United States faces its own boundary. Rapid inflation is not an usable tool. Inflating at a pace beyond 3 to 4% erodes global confidence in the dollar, undermines its role as the primary settlement currency, and accelerates diversification into the euro, the yen, and the yuan. According to International Monetary Fund reserve data, even a 5% decline in perceived dollar stability reduces global reserve allocations measurably. Inflation as a unilateral escape is non-functional, because it dissolves the advantage it seeks to exploit. Similar dynamics shaped the Latin American debt gridlock in the 1980s, when neither debtor nations nor creditor institutions could move without inflicting damage on themselves. The architecture trapped both sides simultaneously, so both sides are locked by the same mechanism. And when two sides benefit from a system for decades, the constraints eventually outlast the benefits. And when constraints outlast the benefits, the original advantage becomes the liability. Cheap debt for the United States and stable dollar reserves for foreign holders defined the early phase of the arrangement. Washington secured long-term financing at yields far below what a system carrying tens of trillions of obligations should have paid. Japan, China, and major European institutions secured predictable collateral for trade, banking, and sovereign reserves. Both sides gained operational certainty. Treasury markets remained deep. Dollar settlement remained universal. Global trade flows scaled under a single monetary anchor. Then the dynamic reversed. Continuous reliance on United States debt made foreign holders structurally dependent on the stability they were reinforcing. Continuous reliance on foreign absorption made the United States dependent on the demand it encouraged. The same features that built multi-decade stability hardened into mutual exposure. Neither side can unwind positions without triggering losses that exceed strategic tolerance. The system transformed from win-win to lose-lose without a single policy change. Benefit created lock-in. Lock-in created fragility. Fragility created immobility. With that dependency established, the outcomes ahead narrow into three possible paths. Stability turning into constraint forces the system toward a limited set of outcomes. An orderly reset remains the dominant path. Probability stands near 55%, based on congressional projections, Treasury Borrowing Advisory Committee assessments, and International Monetary Fund restructuring models. An orderly reset means controlled inflation in the low 3% range, a gradual reduction in real-term debt weight, moderate yield adjustments, and coordinated reserve management with major foreign holders. Markets remain functional. Treasury auctions remain subscribed. Dollar settlement remains intact. The process is slow, multi-year, and politically difficult, but it avoids fracture. Outcome: a contained repricing cycle and a softer landing for global capital flows. A crisis breakpoint sits behind it with an estimated 30% probability. This scenario emerges when interest cost acceleration outruns the Federal Reserve's defensive tools. Yields spike. Treasury liquidity thins. Foreign reserve managers reduce exposure faster than domestic institutions can absorb supply. The Federal Reserve deploys emergency facilities similar to the ones used in 2020 and 2008, but effectiveness diminishes because structural debt levels are higher and global diversification away from the dollar is already in motion. Outcome: temporary disorder, forced policy intervention, impaired credit markets, and a prolonged recovery timeline. A hard collapse carries a 15% probability. This scenario activates when confidence breaks before intervention stabilizes markets. Treasury demand falls sharply. Dollar credibility contracts. Inflation accelerates in a reflexive loop. Borrowing costs exceed sustainable thresholds, forcing an involuntary restructuring. The International Monetary Fund uses comparable dynamics from the Latin American debt fracture in the 1980s to model this probability range. Outcome: systemic stress, sovereign repricing, and long-term damage to reserve currency status. None are ideal. The highest probability path is the long-term controlled reset because it damages the architecture least and preserves the dollar's operational utility. This isn't about choosing sides, it's about managing exposure. System-level pressure always transmits downward. It shows up as value erosion when the real worth of savings declines faster than nominal balances rise. It shows up as volatility when Treasury yields swing, dollar stability weakens, or global capital flows rotate abruptly. It shows up as liquidity stress when credit availability contracts and markets tighten in response to policy signals or confidence shocks. You cannot control the architecture, but you can control the portion of your balance sheet that remains vulnerable to dilution, repricing, or forced policy outcomes. Positioning outside the mechanism requires assets that do not depend on the stability of the liability-based system. Gold remains the primary non-synthetic store of value, immune to monetary expansion and insulated from counterparty exposure. Bitcoin and Ethereum function as digital hard assets with fixed or algorithmically constrained issuance, providing an alternative to currency dilution and long-term debt-driven policy cycles. Productive real assets, such as income-generating businesses, land, or essential infrastructure, retain utility regardless of monetary adjustments because their value is tied to output, not denomination. Here's what this means. Holding assets outside the mechanism reduces vulnerability by limiting your exposure to systemic repricing. If this briefing clarified how the United States manages debt pressure through structural mechanisms rather than visible policy moves, subscribe for the next analysis. This channel delivers intelligence-grade breakdowns of global financial dynamics, reserve currency behavior, sovereign debt architecture, and the hidden systems that determine market direction long before the headlines appear. Staying informed is not optional when the underlying framework is shifting in real time. The next briefing examines the Federal Reserve's most underestimated instrument, the tool that moves, yields, liquidity, and global capital flows, even when the institution remains publicly silent.